You know, everybody has pretty much said their reason about why the crypto markets have recently dumped. Price has dropped. Bitcoin is down. My portfolio is down hundreds of thousands of dollars. Everybody has said their reason. What I want to do is get down to the truth because the people deserve the truth. And what I found in recent history after putting in like at least 30 hours of research is pretty scary. It's really scary. Everybody has heard of Bitcoin being manipulated and Bitcoin dropping because a few people have dumped it. Everybody has heard of this, but has anyone actually gotten to the truth? In this video, I dive extremely deep and expose the single actors that are manipulating the market. This is one, show me the true light of Bitcoin and the cryptocurrency market and how it can easily be manipulated and changed at will. And number two, this also shows that Bitcoin and cryptocurrency is extremely bullish right now. And these select few people cannot hold the market down forever. What's going on, everybody? Alex back with another video, and you guys know when I start diving deep with the research, people start getting exposed. So if something bad happens to me in the future because of what we're doing here on the YouTube channel and the community we've built and everything I stand for, well, so be it. I'm gonna dive so deep into these select few actors and exactly how they have repeatedly, over and over again, dumped the markets and then proceeded to take money from unsuspecting victims over and over and over again. And then I'm gonna show you guys exactly why they are halting the Bitcoin spot ETF. I see a lot of crazy things aligning in one answer, and this video needs to be shared with as many people as possible, especially if they own cryptocurrency. Don't get shaken out by these people. Please don't be shaken out. And I've always thought about exactly what I'm gonna explain in this video, but I just got my confirmation from the crypto Congressional hearing where other people already know and are already trying to change the manipulation standards of these whales or these select actors. Let me jump into the content here, okay? So I'm gonna pull up this video and I'm gonna play it for you guys. And then towards the end of the video, I'm gonna play it again and tell me this doesn't look crazy.
At what point should we become concerned about the possibility of a bubble? Let's start, if we may, with Mr. Brian Brooks.
Well, thank you, Congressman Green. It's terrific to see you again, and I always find your questions extremely perceptive. What I would say about that question is a lot of the price volatility of cryptocurrency has to do with the early stage of the market and the thinly traded nature of the asset compared to, for example, U.S. real estate, global equities, or anything like that. I think the message I'd land with this committee in response to your question, however, is some of the things that make U.S. equity and debt markets more stable and less volatile have to do with the fact that there's a lot more price discovery in those areas. And what I mean by that is, in the U.S. we have regulated equity mutual funds. We have derivatives products and futures products that allow the free trading on a 24/7 basis that provides the market with forecasts of what's happening in the ecosystem. In the world of crypto, the U.S. hasn't responded by developing those tools for price discovery yet. And so the result in a relatively new, relatively thinly traded market is that one person unwinding their position can have a massive effect on the price. The last point I would just make very quickly is something like 80% of Bitcoin holders have never sold a Bitcoin. And so when you hear about a day when there was a giant price drop in Bitcoin, often it turns out that there was one or two large traders who were unwinding a leveraged position, and the vast majority of holders have enough confidence in it that they've literally never sold a unit of it. So I would argue we need more liquidity and more price discovery to tamp down volatility, not less.
Okay, so there's a couple of things I want to point out here that's really important. Number one, the guy's asking about a bubble, okay, and why we have this extreme volatility. He answers by saying, hey, we don't have enough institutional tools and liquidity to make this stable. And what happens a lot of the time is there's one or multiple actors that will bring the price down, but most people, 80% of people, are holding Bitcoin and have never moved or sold the Bitcoin ever. So this is like proof in the pudding right here, and it kind of confirmed my thought process. So I dove deeper, and I'm going to give you guys, again, in this video, ridiculous evidence. I've spent a lot of time, so if you could take 2 seconds liking the video, and of course subscribing to the channel, let me jump into the actual topic here. So first things first, it got a little bit fishy for me when they accepted the Bitcoin futures, but they denied the spot ETF. So if you come over here, you can see the SEC rejects Wisdom Tree spot Bitcoin ETF application. Then they proceeded to rejecting everybody else. So the question is, why would they accept a futures agreement but ban the spot ETF? It doesn't make sense. So let me explain to you for people that don't understand the difference, okay? So the difference is very simple. Stock futures are financial contracts where the underlying asset is an individual stock. Stock futures contract is an agreement to buy or sell a specific quantity of underlying equity share for the future date at a price agreed upon between the buyer and the seller. The contracts have standardized specifications like market lot, expiry date, unit of price quotation, tick size, and method of settlement. So the point is that when you are trading on a futures exchange, you are technically not touching the underlying asset. You are trading on contracts and promises, right? Backed up by law. Now, this is super important because why would they accept this for Bitcoin, but they don't want to accept a spot ETF? And the difference is very simple. A spot ETF allows Bitcoin to actually get taken off of the market. So when you're buying through a spot Bitcoin ETF, you are actually owning the underlying commodity. And that's the huge difference. The original one with futures, you're owning the contract. With a spot ETF, you're owning the actual asset. And this gets really fishy for me because what is the biggest catalyst? I want you guys to think about it. What is the biggest catalyst for cryptocurrency? Very simple. The decrease in issuance of the token itself, the scarcity element, which brings me to my next point. If we look at the narrative of Bitcoin, whether you want to look at this from a legitimate, supply and demand standpoint, which I think definitely has its argument, where you're looking at the stock to flow ratio. This stock to flow ratio is so viral that it actually took Plan B. This is like his biggest work to 1.6 million followers. He is known by everybody in the cryptocurrency community and originally started with the stock to flow ratio. And just to put it in simple terms for you, every 4 years, Bitcoin decreases the amount of Bitcoin that comes to the market in half. This lowers the amount of sell side pressure onto the market because there's literally less Bitcoin on the market. I'm going to show you data, but let me give you proof why this is one of the biggest catalysts for crypto. Whether you're adopting it as a narrative and you just believe this to be true or it actually being true, they both make sense. So if we come over here, you could see the halving cycles every time this is happening with Bitcoin, which by the way, it's hard programmed in, meaning no one can ever change it. Every single time this happens, we have a whole entire market, like a whole bull market happens after this event every single time. And historically for Bitcoin's price, this has been the catalyst. I'm sure a lot of you have heard of the halving event in cryptocurrency. This moves all of altcoins. This moves everything. So what I'm basically trying to explain is this is one of those powerful narratives or legitimate supply and demand, liquidity, however you want to put it, like liquidity crunches. This is the biggest catalyst for Bitcoin and the whole entire market to increase in value. So let me show you how important it is. If you look at this website called Watch the Burn, basically this shows how much Ethereum is being burned. Bitcoin has such an advantage with the decrease in issuance of the supply that Ethereum literally adopted a burning mechanism and put it into their protocol called EIP 1559. They literally adopted this, put it into their protocol just to help with the Ethereum price appreciation. And then there was a lot of narratives and a lot of articles showing that the burn rate that Ethereum has indefinitely is that of 10 different, Bitcoin halving cycles. So everybody started believing in this. And not only that, but the negative issuance also took Ethereum off the market. There is days on Ethereum, if there's a lot of transactions, where Ethereum is taken off the market or burned. And this, again, gives a similar effect to Bitcoin's decrease in issuance. In this case, it's decreasing and sometimes negative. So this is also another confirmation that clearly everyone knows that scarcity moves these markets. It's the biggest catalyst, so much that Binance, BNB, the third biggest cryptocurrency in the market. So the first, the second, and the third all have this burn. BEP 95 will speed up the burning process of BNB. I know you guys seen all of these burning coins and stuff. This is one of the biggest reasons why cryptocurrencies appreciate. And like I said, I'm making a claim that it's probably the biggest narrative in crypto, specifically because look, Plan B, 1.6 million followers. These guys with a lot of money are looking for a risk model. There was no risk model until this came in. Once the stock to flow model came into the market, then everybody basically adopted this narrative of the 4-year cycle, right? So that's so important because it gets a little bit fishy, right? It gets a little bit fishy. Why are they trying to stop more Bitcoin being taken off the market with the spot Bitcoin ETF? They're trying to stop the Bitcoin from being taken away and being hodled like the 80% of people that do that with Bitcoin. And this is super important because what I'm about to go through now is going to be very detailed and really interesting. So this is going to be how to dump the market in less than 5 steps. All right, guys, so we're going to dump the heck out of this market. We're big whales. We have 7 other whale people and some hedge funds and some other entities with a lot of money that are going to follow our move. We're going to dump the market together, and I'm going to break it down for you step by step exactly how it's going to play out. So step 1, we have to create artificial FUD. FUD stands for fear, uncertainty, and doubt. So what we're going to do is we're going to pay financial websites to create articles about some type of FUD narrative, something that people can believe, right? Like China ban news or Bitcoin energy news or an economic activity news, something like this, something everyone can easily justify and resonate with because it's happened before. Okay, so that's step 1. We're going to pay a couple of kind of low-end marketing outlets to make these articles and kind of leave it on the back burner for now. And you guys are going to see how this plays out in the future. Step 2, pay several contributors from Bloomberg, Forbes, and other big financial websites to make hot takes and other articles and cite the original articles, the original FUD articles. So what we're doing here is we're getting the bigger news outlets to cite and give credibility to the original small articles that we paid for in the beginning. And it's basically building this kind of perception of what we're saying here is really true. And the reason why this works is because of 3 reasons, okay? Very simple. Number 1, writers are always desperate for new content. Number 2, they literally make money if they generate traffic to the website. Number 3, in writing and content creation, velocity is rewarded more than quality in media. They have an incentive to pump out as many articles as they possibly can, and it's hard to quality control these articles, and sometimes they post false information. So this is really easy to get by them, especially if you created the artificial FUD in the beginning and then you paid Bloomberg, right? Because you could just say something, hey, Bloomberg's talking about it. They have credibility. Let's jump on it. You're missing the story, right? Which brings me to step 3, build a network of high profile writers and get them all at the same time to FOMO as hardcore as possible into the story. So you're going to tell them, hey, you're missing out on this article over here. You're missing out on this news piece. You got to get on it, right? Befriend 50 to 100 different writers and maybe 20 or 30 of them. And remember, these are high profile people, will make an article about it. And this basically makes the other articles you created way more credible and legitimate. And it starts to go viral. It starts gaining momentum. Here comes the influencers, the people that make content for a living, the YouTubers, the Twitter accounts, right? These guys basically make their their news off of what they see in articles and what they see, Bloomberg talk about and all this credibility. They start making their videos. They start, pumping out their tweets and making Instagram posts. And then what happens is we have all the websites with their algo trading bots looking at the key phrases, and the key phrases are saying ban, hack, dump, bear market, saying all of these negative phrases, and you're kind of slowly changing the sentiment. And then number 4, you want to find and expose their weakness. And you do this with the opposite of an OTC bot. We're whales. We've been doing this for a long time. So we've created a couple of algorithms that can literally identify an exchange with extreme low liquidity, super low liquidity for the Bitcoin pair. This is the opposite of an OTC desk. Typically, OTC algorithms will look for the highest liquidity. So when you buy Bitcoin, you don't move the markets. You're looking for the exact opposite. You're looking for the order books with the lowest liquidity. And then what we want to do all together at the same time is sell as much Bitcoin as possible on this exchange. And what this does is it causes a flash crash to happen on this specific exchange only for Bitcoin's price. And then from there, we actually change the price of Bitcoin on the big websites like CoinMarketCap and CoinGecko, because all they are indexes of all the exchanges. So they pull their data from 20 different exchanges. And if we see one dropping down, you can affect the price of the big Bitcoin price that you see on CoinMarketCap and CoinGecko. And then from there, we have effectively brought down the price of Bitcoin. And if it doesn't drop, we can get more people on our team, get more whales, get more people with a lot of money to help us dump the market even more. And from there, we actually have created an artificial dump in Bitcoin's price. And then what happens is very simple: the amplification of network effects. Number 5, retail, see dump. Retail comes in, they look at dump, they get manipulated. They don't understand what FUD means. They run to the news outlets. They see all the news outlets confirming their bias. Bitcoin is about to dump. All news outlets and influencers are endorsing the market dump. They panic and start to sell as well. They'll even sell at a loss to get out of the market because they're very scared at what's happening. Then the algos that are looking at sentiment start to dump as well. And everyone's calling bearish, bearish, bearish. And this cascading effects gets us to our last point, where we have over leveraged Bitcoin in the market, way too over leveraged. We stop hunt people out of their positions, and this artificial extreme dump happens right in front of your eyes. And this is how Bitcoin drops 10, 20% in a couple of hours, very quick, because of this artificial dump. Now, this is just a story, of course. I want to give you a theory on how they do it. And now I'm going to back this up with ridiculous amounts of on-chain metrics and evidence. So if you come over here, there's only one way to stop this negative cascading effect of people being liquidated on these manipulated exchanges and the sentiment being turned over that quickly. And it's taking Bitcoin off the market. The same thing they want to stop with the Bitcoin spot ETF. So if you look over here, this is Bitcoin net transfer volume from two exchanges on all exchanges. Basically, when this goes down, we see Bitcoin leaving the exchanges, and this pops up. That means Bitcoin is coming on to the exchanges. What are people typically doing when they put Bitcoin on it? They're probably going to trade it. They're probably going to sell it. If they take it off the exchange, they're probably looking to hodl it or hold it in some type of position. You could pretty much see every time we have an abnormal spike in Bitcoin leaving the exchange, right? We have an increased price almost immediately after. So in almost every abnormal situation, you see these huge ones right here. We see that Bitcoin literally either stops the dump, the dump stops or slows down, or the price increases, okay? You can literally see it here, right here, boom, price increase, boom, helped increase price, boom, helped increase price. Same thing here, increase price. Same thing here, increase price. You can see it all over, right here. It lines up pretty much every single time. And look, right here in this case, it stopped the dump. Right here, increase price. Right here, increase price, right? Very simple, straightforward. Now, I want you to look at where we're at now. Look how abnormal this is. More and more people on a consistent basis are pulling Bitcoin off the exchanges. You can see it's more consistent. We get these huge spikes But right here, it seems like people are wisening up. Here, it's like a select few actors that are taking Bitcoin off the exchanges, whether it's whales or the actual people that dumped it themselves. I don't know the difference anymore, but basically right now, people are getting smarter and everyone's pulling it off the exchanges. We're getting more consistent net transfer volume off exchanges. I thought that was very interesting. I'm going to back it up with even more evidence. This is Bitcoin's issuance since it started. So this is showing the halving cycles. You can see when the issuance dropped right here, price increased and we basically started the bull run. Same thing here, price increased, basically started this bull run. Here is what we just experienced, started our bull run. So this is adding to what I'm saying. They don't want to take Bitcoin off the market. They just don't want to do it. And it's the same thing for Ethereum. You see this downtrend right here, which immediately brought the price up. And then in the longer trend is getting the price of Ethereum up. And this is the issuance of Ethereum. EIP 1559 was August 4th. So we can literally see it right here, EIP 1559, where they upgraded Ethereum protocol and integrated the burn rate. Since that date, we have been pretty much trending down. So that's really interesting. And then just to add to the liquidations and how it artificially brings the price of Bitcoin down, like these guys can't bring Bitcoin down 20%. They can bring it down like 5 to 7%. And then what happens is they just bring it down enough when people are over leveraged and there's too many longs. They bring it down enough to get everyone liquidated, and then that brings down the market even more. Here's evidence of that. If we bring it over here, you can see the price drop before the liquidations happened. So price dropped, and once the liquidations happened, we had another drop down here. It got bought up a little bit, but same thing happened again. When you get these really vertical drops in Bitcoin's price in very short periods of time, this is usually always linked to liquidations, right? So this is exactly what I'm saying. Regulation for crypto is a good thing, right? It's exactly what he was saying in the beginning video. And if we see it again, more evidence, right? Liquidations right here, very simple. And this is for Ethereum. Bitcoin's even worse. And if we come over here, same thing happening right there. I'm not looking to waste your time. It's pretty obvious. Every YouTuber and everyone that says this is a common thing. They literally stop hunt people out of their positions and get them liquidated to bring the price of Bitcoin further. Leverage in Bitcoin is a bad thing. Now, I'm going to even give you even more evidence how crazy this is. Now, this is basically showing the illiquid supply versus the liquid supply. So liquid meaning it moves a lot, right? There's a good chance it could be sold. It's being traded. It's being moved. It's liquid. It's like water, okay? Illiquid means it's like ice. It's staying in the same position for long periods of time. So let's look at some different case scenarios so you guys can kind of see the trends here. So let's look at the illiquid supply first. As you can see, this blue line is just going straight up. More and more Bitcoin is becoming illiquid, meaning not moving. Okay, so I'm just going to take that out. Let's look at, for example, a liquid supply. So Bitcoin is becoming less and less liquid. As you can see, there is a trend downwards. Bitcoin is becoming less and less liquid. People don't move Bitcoin that much, okay? This is why they don't want to spot Bitcoin ETF, because they're scared people are just going to take Bitcoin off the market and never move it again, okay? Let's take this off right here. Let's look at highly liquid supply. So super liquid, okay? And this is also on a downtrend. And you can see it was on an uptrend. It was becoming more and more liquid. And then we had the Black Swan event, which happened and brought the price of all markets down. And then since then, right, it's on a downtrend, okay? It's not more liquid, it's less liquid. This is highly liquid supply. So this is on a downtrend. It's becoming less liquid, all right? Super interesting. Not only that, but we can look at another metric, which is illiquid supply shock ratio. So this is showing kind of like how much supply shocks happen and how it's illiquid, right? So as you can see here, this is on an uptrend. More supply shocks are happening, right? Which is helping with Bitcoin's appreciation over time. And then let me just bring it to the last thing. Let's look at liquid again, highly liquid supply. You can see it's on a downtrend, confirming pretty much everything I'm saying. These are all lining up. On-chain metrics look super bullish. Now, I just want to be very clear with you guys. The reason why on-chain metrics looks bullish and then every other indicator when it comes to price and technical analysis looks a little bit bearish is very simple, because on-chain metrics have to do with cryptocurrency that's not on an exchange to be manipulated, right? Literally think about this. I'm telling you guys right now that they have algos that look for the lowest liquidity for the pair and they try to dump it on that exchange. All the manipulation happens at the centralized exchanges. So the reason why everybody, Willy Woo, all these people, all these big influential characters are saying Bitcoin bull run, bull run, bull run is because on-chain metrics looks really, really, really good. And this is adding to the fact that, like I said, these centralized exchanges with the over leverage is the starting point of manipulation. They start with sentiment and they bring it all the way down to the literal price on a centralized exchange, which, by the way, most retail uses because of the cheap transaction fees and because of the convenience. Most retail are the ones that get taken advantage of on these centralized exchanges. And if we come over here, you can see proof of the sentiment of what I'm saying. We're looking at May 1st, 2021 through May 8th. This is literally the exact time period right before the original dump of Bitcoin. And let me show you what I'm saying. So if I pull up Bitcoin here, this exact time frame was the original dump right here when we were making our way to all-time highs. Look, April right here, May, and May 8th was the literal last day. Let me pull it up for you guys right here. Look, May 8th, literal last day before this huge cascading down dump effect right here. What was being said in the news before the dump? This is very clear. Before the dump, what was being said in the news? Because remember, we told you for our dump the market strategy, basically you have to change the sentiment artificially. You have to put this news out before the price even drops. So if we come over here, you could see that all I'm doing is looking up Bitcoin news right here from May 1st to May 8th. And look at all of the headline news. Charlie Munger calls Bitcoin disgusting. And it's funny because he's a banker. So did someone pay him? I don't know. Like, he can make money off of Bitcoin too. Why not, right? These people are smarter than you think. Forget Bitcoin. Here's the crypto assets to follow. Bitcoin's crypto dominance declines as Ether soars past $3,000. Ethereum is leaving Bitcoin in the dust. Bitcoin gets Wall Street attention, but its power lies in, it's all negative, right? Goldman Sachs offer, okay, it's mostly negative, but look at the headline news, CNBC, right? This is the headline news with the most traffic from May 1st to May 8th. So you could see that the sentiment was obviously changed. It's called trending up the chain. It's a common thing that people do to go viral. They're just using it as a negative way to spread FUD. They're making the FUD go viral, and then they're making it real in price by dumping a specific exchange. It's actually really, really scary. But now let me bring it home with you guys, and let's listen to what he has to say one more time. After listening to all the evidence I displayed here, I'm gonna play the video one more time for you, and then you guys tell me what you think in the comment section below. Let me know, what is your thoughts on the situation? Do you think I'm right? Do you think I'm putting too many pieces of the puzzle together and it's a theory or a conspiracy theory? Let me know in the comment section below. I'm gonna play it one more time for you guys.
At what point should we become concerned about the possibility of a bubble? Let's start, if we may, with Mr. Brian Brooks.
Well, thank you, Congressman Green. It's terrific to see you again, and I always find your questions extremely perceptive. What I would say about that question is a lot of the price volatility of cryptocurrency has to do with the early stage of the market and the thinly traded nature of the asset compared to, for example, U.S. real estate, global equities, or anything like that. I think the message I'd land with this committee in response to your question, however, is some of the things that make U.S. equity and debt markets more stable and less volatile have to do with the fact that there's a lot more price discovery in those areas. And what I mean by that is, in the U.S. we have regulated equity mutual funds. We have derivatives products and futures products that allow the free trading on a 24/7 basis that provides the market with forecasts of what's happening in the ecosystem. In the world of crypto, the U.S. hasn't responded by developing those tools for price discovery yet. And so the result in a relatively new, relatively thinly traded market is that one person unwinding their position can have a massive effect on the price. The last point I would just make very quickly is something like 80% of Bitcoin holders have never sold a Bitcoin. And so when you hear about a day when there was a giant price drop in Bitcoin, often it turns out that there was one or two large traders who were unwinding a leveraged position, and the vast majority of holders have enough confidence in it that they've literally never sold a unit of it. So I would argue we need more liquidity and more price discovery to tamp down volatility, not less.
Well, look, Mr. Brooks knows what he's talking about. He knows what's going on in the background. I think it's very suspicious that the Bitcoin ETF, the spot ETF, was denied, but the future one was accepted. I think taking Bitcoin off the market is exactly what they don't want to happen for two reasons. Bitcoin will get way too expensive and they want to buy more. And for the second reason, they won't have their really, really good effect of dumping the market, whoever it is. Not pointing fingers, but they won't be able to dump the market as aggressive anymore and manipulate people out of their positions. And just to bring it home for you guys one more time so you understand how crazy this is, let's look at Bitcoin's price one more time. If we pull up the original dump, I want to show you the end of the dump right here specifically. Let me take this off the chart. Right here, we have an extremely long wick. And the importance of that is this is people buying it back on the daily. So the daily price did get down to 30K Bitcoin, but people brought it all the way back. This is basically people taking it off the exchanges and hodling it. This is whales buying it. This is people that are smart enough to buy the dip and dollar cost average. As you can see, it brought the price back up to 36, but we were down all the way to 29K. And the importance of that is that it shows instability in the dump. This is the single actor right here. And then it brings it down. And this is the cascading effect. And this is the people getting liquidated on leveraged longs. And then this is people buying the dip. This is people taking it on chain. This is people putting it in cold storage wallets and saving it forever. This is the negative issuance here. And if we come over here, I want to point out one quick thing to you. Same thing happened again. Select few actors. Drop cascade liquidations. Look at this wick. It's shorter than the last one. It's shorter than the last one. Let's look at the percentages. And this gives me hope. 18% down. This gives me hope. 14% down. Although it's not a lot, people are wisening up. And like I showed you right here, very simple. There is more consistent, right here, you are here. There's more consistent amounts of Bitcoin being taken off the exchanges. Now it's not a select few whales. Now it's people that know what they're doing. Now it's people that educated themselves. Now it's people that have done the due diligence and they believe in Bitcoin in the long run. So this is my case for exactly why the markets dump. And I think it's the best case on the internet. But yeah, that's it for this video. If you like the quality of this content, hit like. If you don't, leave some constructive criticism, subscribe for more video updates. And like I always say, if you don't get with it, you will get left behind. Thanks for watching this, guys. Catch you in the next one.